An option is a contract that allows you to buy or sell a unit of the underlying asset in the future at a fixed price. Options come in call and put varieties. Let's take a closer look. Suppose that the current value of a company's stock is $100 per share. The buyer enters into a contract that grants the right to buy the asset at $100 per share for a limited period of time. This type of contract is called a call option, and the set price in the option contract is called the strike price. For the purpose of this example, we will say that the cost of this contract is $2. In other words, this is the price of the option. Let's look at 3 possible scenarios. Scenario 1. The share price increases to $120 in the given time period. In this case, the buyer can exercise the option to buy shares at $100 and immediately sell them for $120, earning $20 minus the $2 that was paid for the option, for a total profit of $18. This is 900% of the $2 investment. Scenario 2. If the share price drops, for instance, to $80, it isn't profitable to use the option and buy shares for $100. So the option runs out and the buyer loses the $2 invested in the option. Scenario 3. If the share price increases to $102, the income will be $2, which covers the amount paid for the option. This share price, beyond which the trader will make a profit, is called the break-even level for the purchased option. A put option works the same way, but in the opposite direction. With a put option, the option holder has the right to sell shares at a predetermined price. In the example above, where the share price drops, with a put option, the trader can buy the stock at $80 and sell for $100 as set in the option contract, thus making a profit. A special feature of classic options is that you don't have to wait for the expiration time in order to exercise the option. For example, a trader bought a put option for the same $2 and an hour later the asset price fell to $80. The trader can sell the option whenever he wants in order to make a profit. The fixed price for buying or selling shares under a contract is called the strike price. In our previous example, the strike price was $100. For a call option, the higher the strike price is compared to the current share price, the cheaper the option. This is because the price is less likely to reach a higher strike price, although the potential profit is greater. Now consider a call option, in which the strike price is below the current share price. Options with strikes like these are called in-the-money options, since you are already making a profit. But the cost of such options is much higher and the profit percentage is lower. For a put option, everything works exactly the opposite. The higher the strike price is compared to the current share price, the more expensive the option. The lower the strike price, the cheaper the option. The expiration time is the deadline for using the right to buy, call, or sell, put, the asset at a fixed price, the strike price. The expiration usually falls at the end of the work week. This means, for example, that you can buy an option for the end of the current week or the following week or for the last week of the selected month. The farther the expiration is from the current date, the more likely the price of the asset will move in the direction the buyer wants, so the more expensive the option. The cost of options is determined by the market. We use 13 option exchanges. Market conditions depend on a combination of many factors: supply and demand among traders, price volatility in the past, time to expiration, and more. How to trade binary options. When trading binary options, you should predict the asset price direction, whether the price will go up or down compared to the opening price. A buy position, call option, will result in a profit if the closing price is higher than the opening price. A sell position, put option, will result in a profit if the closing price is lower than the opening price. Otherwise, your deal will result in a loss. Specify the amount of your investment by pressing the Amount button on the right-hand side panel. Choose the expiration time by clicking the Time button. After the expiration time, the option is no longer valid and cannot be used. The expiration time is shown on the chart by the red solid line. The white dotted line on the chart is the purchase deadline. Up to this time, you can buy multiple options of the same asset in the chosen direction. Choose the direction of the price movement. If you suppose the price will go up, click the green Higher button. If you expect the price to go down, press the red Lower button. After the transaction crosses the red line and expires, you will see your result, either a green window with the earned profit if the prediction was correct, or the red window with the amount of loss if the prediction turned out to be wrong. In binary options trading, it doesn't matter how significantly the price changes. If the closing price is equal to the opening price, your initial investment into a deal will be returned back to your account. How to trade digital options. On the right-hand side, the chart is accompanied by several price levels. These are strike prices, or in other words, target levels that the opening price should go above or below for the position to close in the money. When choosing different strike prices, you can see how the profitability is changing on the higher and lower buttons. It depends on whether the asset price can reach the set strike level in the chosen direction or not. The lower the probability that the price reaches the strike level, the more the profit, up to 900%. Choose a strike price. Then specify the amount of your investment by clicking the Amount button on the right-hand side panel. Choose the expiration time, the moment when the option ceases to exist, by pressing the Time button. The expiration time is shown on the chart by the solid red line. The dotted line on the chart indicates the purchase deadline. Up to this time, you can buy as many options of the same asset as you wish at different strike prices and both in the higher and lower directions. Now select the direction of the price movement. If you think the closing price will be lower than the chosen strike price, click Lower. If you expect the closing price to be higher than the chosen strike price, press Higher. After the transaction crosses the red line and expires, you will see the final result, either a green window and the earned profit, or the red window and the amount of loss. Have a nice trading experience.